Yeah, so if you look at the 70s, it's really about the type of inflation you're getting. And so in the 1970s, a lot of that inflation was coming from bank lending. And so basically, if you look at the demographics curve of the United States and much of the rest of the world, basically that was kind of like, a very high level of population growth, especially population coming into adulthood. And so there's a lot of kind of, household formation, bank lending, and then that was exacerbated by the fact that there was a fiscal deficit. But if you look at a long-term chart, the deficits were not massive compared to other parts of history. It was that combination of that bank lending and then fueled by the deficits. Plus, you had oil production in the United States peaked in 1970. And so you had a real constraint that you ran into where you had to start importing your oil while you also had that very strong demand growth. And so there are a bunch of factors that led into that inflation, combined with the fact that you went off the gold standard, and so you lost that anchor. But if you look at the 1940s, it's a much different story because the inflation was not driven by bank lending. It was driven by massive fiscal spending to obviously to fight World War II. But most of that spending is domestic, right? So you're funding factories, you're funding all this stuff, and when the war's over, you're repurposing those factories. You're doing GI bills to send people, 8 million people to college and technical schools and get them set up with mortgages, things like that. So basically, that was a very fiscal heavy environment, and also debt levels are very, very high, especially in the federal sector. And so when you had that very high inflation, they were unable to raise interest rates. They just had to hold rates low and let the inflation kind of burn away a lot of the debt. Whereas in the 70s, because debts as a percentage of GDP was so low, they were able to raise rates to try to combat inflation, and eventually Volcker was able to do that. And so there are a bunch of different factors. If we look at the 2020s, so far it's more like the 40s in the sense that the debt picture looks very similar. And the inflation we're seeing is not coming from bank lending, but rather is coming from that fiscal sector. The fiscal spending, basically a war on COVID or a war on, however you want to phrase it. Basically, the president has referred to it as kind of wartime spending, right? That's kind of how they're looking at it. And that's how it's showing up in the long-term chart as well. So a lot of the money creation is not coming from banks lending, but from the fiscal sector spending it into the economy and then having a lot of their bonds, purchased on the secondary market by the Federal Reserve. So they're clearly now, I think the whole purpose was to basically be behind the curve because they know they cannot raise interest rates to say positive real levels, right? So if inflation is currently 6% official CPI, they can't raise it to 7% given how much debt and interest that would be on the debt. And so really it's about kind of expectation management. They were kind of playing down. They were kind of saying it was going to be transitory. And that was clearly not the case, or at least, not as transitory as they thought. Now they're kind of, I think they're catching up and they're going to try to tighten. But they're tightening from a position of being behind the curve. And it's one of those things where it's not even clear that tightening would have much of an impact on inflation because the inflation is coming from the fiscal sector combined with real world constraints like supply chain issues and other things like that. And so I think they're going to try to tighten until something breaks. Either yield curve inverts or credit markets break, which is what happened in late 2018. That's kind of what made Powell have to, the famous Powell pivot where they were on autopilot and then credit markets broke for 6 weeks and then they were not on autopilot anymore. Or you could have a treasury market dysfunction like you saw in March 2020. I don't think we're close to that. So I would really watch credit markets and the yield curve to see what kind of things happen. But essentially, I think they're mandated at this point. They have kind of the dual mandate and then they have kind of the underlying mandate. So the dual mandate is maximum employment and maintain, keep a lid on inflation. And with inflation way above trend, while a lot of the employment numbers are looking somewhat better, at least on the surface, I think they're clearly shifting towards that controlling that inflation side. Their third kind of unstated mandate is to maintain financial stability. So you can't have treasury market go illiquid. You can't have high yield bond market go illiquid. And so they if you see kind of damage in one of those areas, they put out the fire there. So they're juggling all these different things, and right now inflation is the one that they're getting heat for, and so at least for a period of time, that's the one they're going after to put that fire out.
Don't we still have supply chain issues causing some of this inflation?
Yeah, basically there's a demand side and there's a supply side. And at any given time, supply is not infinite, right? It can't just change on a dime. And so we had basically a lot of fiscal stimulus, which gave everyone the ability to consume more. We increased everyone's demand in a world where we have real world constraints. And especially because people are locked down, some of the constraints are even tighter than before rather than increasing. And so that combination of that demand and that supply. The only way that the Fed tightening can potentially impact that is by reducing demand, right? If they make stocks fall, if they make banks lend even less than they are now, that can basically reduce consumer demand, and then ironically that can at least potentially in the temporary term kind of quell inflation. I think the bigger thing to watch is fiscal spending, because that's the thing that has a more durable impact on inflation. So 2020 and early 2021, we had these big fiscal stimulus bills. The infrastructure one is not really kind of near-term focused, so that's more of a long-term thing, and it's not as big as some of the others. And so right now we're looking at a fiscal cliff for 2022, where they're still kind of debating on that other bill. We'll see what they get through, but assuming they don't get anything big through for 2022, then a lot of that fiscal spending dries up, and you should see a reduction in how fast money supply is growing. Now, those supply chains are still there. I mean, we're still short on truckers. We're still short on ports capacity, things like that. I mean, this doesn't work itself out very quickly. And it's also a global market, right? So it depends what China's doing with their economy. It depends what Europe's doing with their economy, some of these really big sources of demand. But basically, I think the base case going forward is that, the November inflation print's going to be pretty hot, I think. I mean, right now economists are expecting that the year-over-year numbers will be higher than the prior month, but that month-over-month will be a little bit maybe lower, right? So you could have basically that inflation's still going higher kind of in that intermediate term, but maybe that it's leveling off. And if you start to see signs that it rolls over, I wouldn't be surprised, because when you have kind of a lag after fiscal stimulus, you'd eventually see inflation kind of peak and then maybe roll over as well, subject to whenever the next fiscal stimulus is, or subject to if you start to see kind of a persistent rise in wages, right? Because if you get that wage price spiral, right? So I think inflation's sticky, but I think too many people think linearly. They assume it's going to be a straight line. Whereas if you look at the 40s or the 70s, both those periods, inflation was not a straight line. You'd see inflation go up, and then it would cool off a little bit, and then it would go up again. And there are a bunch of factors there. There are different kind of shocks that happened to the system. There was different attempts by the Federal Reserve or fiscal authorities to kind of rein it in. There were price and wage controls in some cases. And so there are a lot of those things that impact demand and supply to watch out for. And I don't think the 2020s are going to be a straight line either.
How long do you think this inflation problem will be around?
It depends on a couple of variables, especially related to China and the United States. But essentially, my base case has been for a while that the 2020s are going to be a more inflationary decade than the 2010s. And that's not a super high bar to cross. So I think there's a big range for how that could turn out. And I think the biggest factor is probably what happens with fiscal stimulus in the United States, Europe, and China. That's kind of the big question for how inflationary this period is going to be. I think we're going to be in a period of kind of persistently negative real yields. So I think basically bond yields are going to be below inflation for much of the decade, regardless of how high inflation is. So if inflation comes back down for a period of time to maybe be 2%, 3%, right, it's still higher than bond yields are, let alone when inflation officially is over 6% or, could touch 7%, who knows. So I think basically we're in an environment of kind of financial oppression where you have bond yields super low. Inflation's currently moderately hot, by historical standards. It's hot over the past couple of decades. And I think that basically we're not going to have a straight line, but the 2020s could very much see more of this. For example, I can imagine a scenario where they try to tighten policy. They kind of rein inflation in for a period of time because there's no more fiscal stimulus coming. And then you kind of start rolling over a little bit. And then, people demand more fiscal stimulus and they, something happens in markets and they do another one. And we kind of start this multi-year cycle all over again. So I think we have to watch things in rate of change terms.